Is the AI stock BigBear AI a deeply undervalued hidden gem? Or is it a falling trend value trap, flashing just massive warning signs for everyday investors?
Yeah, that's the multi-million-dollar question right there.
Exactly. And that is exactly what we are answering today. Welcome to the deep dive, everybody. Before we get into the weeds, do us a quick favor, like the video, subscribe to the YouTube channel, and you have to leave a compulsory comment down below with your feedback or your own take on the stock.
We really do want to hear your verdict on this one because well, it's highly contested.
Very contested. So let's set the stage. Today is April 19th, 2026.
Yep.
BigBear.ai, ticker symbol BBAI. It recently closed at $3.85, which is up 2.67% for the day.
Right, a nice little green day.
Yeah. But the mission today is to look at the cold, hard facts from our stack of sources. We're talking financials, insider trading data, technical analysis, just trying to make sense of this wild, volatile stock.
And we always have to say this deep dive is just a natural debate of the data. It is absolutely not financial advice.
Right. We're just looking at the mechanics of the market. And giving some context here, the stock has been on a total wild ride. I mean, it's trading significantly below its 52-week high of $9.39.
But it has bounced off its lows, right?
Yeah, bounced off a low of $2.36. So we're kind of caught in the middle right now.
The market is clearly having a profound disagreement about what this company is actually worth.
Yeah.
I mean, when a stock falls from over $9 down to the twos and then rallies back up to nearly $4, you're basically watching a tug of war between two entirely different philosophies.
Right. And to understand that tug of war, we really have to look under the hood at the company's fiscal year 2025 financials. Because the income statement and the balance sheet, well, they're telling two completely contradictory stories.
They really are. It's night and day.
Let's start with the bleeding, the income statement. So annual revenue dropped 19.3% from 2024, falling down to $127.7 million.
Which is, I mean, a nearly 20% contraction in top-line revenue for a company in the artificial intelligence sector. That is a massive structural warning.
Right, because everyone expects AI to just be printing money right now.
Exactly. We're talking about an industry where the market essentially demands hyper-growth. Investors are pricing AI companies based on their ability to capture emerging market share. So when an AI company posts double-digit shrinkage, it signals that their core legacy products are losing relevance, faster than their new products can replace them.
Yeah, and the bottom line looks just as bleak. I mean, they posted a net loss of $293.9 million for the year. That breaks down to 82 cents per share.
Wow.
And the operating loss alone was $74.3 million, alongside an operating cash flow of negative $41.9 million.
And see, that negative $41.9 million operating cash flow, that is the most critical number in the whole report.
Why that specific number?
Because it means the day-to-day business operations are just not sustaining themselves. The core engine of the business, it's costing more to run than it's producing. They are burning cash just to keep the lights on and pay their staff.
Right, so if we just isolate the income statement, the thesis is pretty straightforward. The underlying business model is currently failing.
Exactly.
But then you flip over to the balance sheet and the narrative just completely inverts. It's wild. Despite burning through over $40 million in operating cash, BigBear is sitting on a massive $462 million cash position.
Which sounds impossible, right?
Right. They achieved this through these really aggressive strategic debt reductions. They actually converted $125 million in notes directly into equity, wiping out over 90% of their total debt.
Yeah, 90%.
So, okay, let's unpack this for a second. It's like having a friend who just took a massive 20% pay cut at work, right? They're bleeding money every month on their living expenses. But somehow you go over to their house and find out they managed to completely pay off their mortgage and they have $500,000 just sitting in a high-yield savings account. It's financially baffling.
That's a great analogy. And what's fascinating here is the mechanics behind how they actually achieved that. By converting that $125 million in debt into equity, management basically traded ownership in the company to eliminate their obligations.
Right. The lenders agreed to take shares of BigBear instead of cash repayment.
Exactly. So they flooded the market with new shares. They diluted the existing shareholders to save the company.
Which hurts if you were already holding the stock.
Oh, absolutely.
Yeah.
When you issue that much new equity to cover debt, you mathematically reduce the value of every existing share.
Mm-hmm.
The pie stays the same size, but you've just cut it into millions of smaller slices.
Right.
That dilution is a huge driver behind the stock's massive drop from its 939 high. But you have to look at what that dilution bought them. By wiping out 90% of their debt, they eliminated the crushing interest payments that were just accelerating their cash burn.
So they secured a lifeline.
Yes, sitting on that $462 million cash buffer, they bought themselves the runway they desperately needed for their 2026 growth initiatives. Even as their core revenue shrinks, they have a massive war chest now.
So they basically built a fortress out of a sinking ship.
That's a perfect way to put it, yeah.
But, okay, if management just engineered this brilliant survival tactic, right? Securing almost $500 million in cash and extending their runway, you would expect the architects of that plan to be doubling down on their own stock.
You would think so, yes.
But we are seeing the exact opposite. If we look at the inside scoop, insider sentiment is currently heavily negative.
Yeah, insider selling it always forces us to question the management's internal projections.
Well, get this. CEO Kevin McAleenan just sold roughly $206,000 worth of shares between March 31st and April 1st, 2026.
Right.
And prior to that, Director Pamela Joyce Braden dumped 80,000 shares at exactly $4 a share on March 16th. So I have to push back on the bullish narrative here.
Go for it.
If this company is genuinely positioned for an AI boom and they just cleared their debt and they are sitting on a mountain of cash, why are the CEO and a director cashing out at roughly $4 a share? That is miles below their 52-week high. I mean, it looks like they are rushing for the exits while there is still liquidity in the market.
It's a huge red flag,
Yeah.
and it highlights a severe disconnect in how the market is valuing the future of artificial intelligence. Because you have insiders taking liquidity at $4, seemingly content with that exit price, right?
Yeah.
Yet if we look at Wall Street analyst ratings, the consensus right now is currently a hold to moderate buy, with an average price target of $5.50.
Wait, really? $5.50?
Yeah, which implies a 43% upside from the current $3.85 level.
So how do analysts justify a $5.50 price target when the top executives are selling at $4 and the company is shrinking by 20% annually? Doesn't make sense.
Because the financial modeling for AI stocks is completely fractured right now.
Yeah.
We are dealing with two entirely different valuation languages.
What do you mean by that?
So on one side, we have narrative fair value. This model looks at the total addressable market of government AI contracts, BigBear's massive new cash pile, and the speculative potential of their tech. Under the narrative model, analysts are pricing the stock at $6.67. It's highly undervalued in that view.
So they're valuing the dream, what the company could become if they capture even a tiny fraction of the defense sector's AI budget.
Exactly. Buying the narrative rather than the current reality. But on the other side, you have fundamental discounted cash flow models, DCF models.
Right, the traditional metrics.
Yeah, DCF models, they do not care about total addressable markets or AI narratives. They evaluate the actual free cash flow a company generates today and discount it into the future. Because BigBear's revenue dropped 19% and they're burning $42 million in operating cash, the fundamental DCF model prices the stock at a dismal $1.80.
Oh, wow. 180.
Yeah, so by traditional metrics, it is severely overvalued at $3.85.
Okay, so 667 based on the AI narrative and 180 based on the cold, hard cash reality. So if the fundamental models and the insiders are clashing with the Wall Street narrative, we should see a literal tug of war playing out in the daily trading volume, right?
Absolutely.
Let's turn to the technical analysis to see who is actually buying and selling in the broader market.
Yeah, the charts strip away the opinions and show us the raw mechanics of supply and demand. So looking at the trend of momentum, BBAI is definitively caught in a long-term falling trend. However, it is flashing serious short-term recovery signals. Like you mentioned earlier, the stock recently spiked 26.23% from its March 30th pivot bottom.
And the momentum indicators are really reflecting that bounce. The RSI over a 14-day period is sitting right between 56.7 and 60.6, which is basically signaling a neutral to buy stance.
Yep.
And the MACD is sitting at 0.100, showing a clear bullish crossover. So we basically have the short-term buying momentum fighting against a massive overarching downtrend.
And the moving averages confirm just how trapped the asset really is. At 385, it's trading just barely above its 50-day simple moving average, which is at 384.
Oh, that's tight.
Very tight. But it remains buried well below its 200-day simple moving average, which is looming way overhead at 573. The buyers are stepping in at established support levels, though. We're seeing strong floors holding at 378, 370, and 355.
Okay, so there's a floor, but the upward moves are being capped, right?
Yeah.
Initial resistance is at the recent intraday high of 413, with a major pivot ceiling waiting at 480.
Exactly.
He is where it gets really interesting for me, looking at the market activity. Level 2 data is showing significant liquidity pools forming near 394. And the recent trading sessions have seen just massive volume, 46.29 million shares trading hands on these upward moves.
That is a ton of volume.
Right. So if you visualize this, the stock is basically trapped in a pressurized room. The floor is that 378 support. The ceiling is the 413 resistance. With over 40 million shares of volume pumping into that tight channel, the pressure is just escalating. One of those boundaries has to shatter.
Yeah, high volume consolidating in a tight channel almost always precedes a violent breakout. The tension comes from who is on the other side of those trades. Retail investors are likely buying the AI narrative, providing the upward pressure. But remember that 125 million debt-to-equity conversion.
Oh, right. The lenders.
Yes. The lenders who received millions of newly minted shares are highly likely to be the ones providing that overhead resistance. They're systematically unloading their equity into the retail buying pressure to secure their capital.
Wow, okay. So synthesizing all of this contradictory financials, the insider selling, the fractured valuation models, and these pressurized technical charts, it brings us to the ultimate debate. Is this stock an undervalued gem, or is it a retail value trap?
Let's lay it out.
Yeah, let's outline the bull case first. The absolute best case recovery scenario centers on a massive, growing contract backlog of $400 million.
That 400 million backlog is the cornerstone of the bullish argument. It represents future contracted work, primarily with government and defense clients.
And they are aggressively expanding the scope of that work into secure generative AI. They recently acquired a platform called Ask Sage, which is explicitly targeting $25 million in annual recurring revenue, or ARR. So how does Ask Sage actually change their positioning in the defense sector?
Well, it addresses a really critical bottleneck in government technology. I mean, you can't simply plug commercial AI platforms like ChatGPT into the Pentagon or defense contractors.
Right, the security would be a nightmare.
Exactly. The security risks regarding data sovereignty, classified info, network isolation, they're just too severe. Ask Sage provides a secure, localized architecture for large language models. It lets government agencies utilize generative AI while keeping their proprietary data entirely within their own secure firewalls.
That's huge.
It is. The bulls argue that this acquisition positions BigBear perfectly for the impending wave of Department of Defense modernization. They have the tech, they have $500 million in cash, and they have $400 million in the pipeline.
Okay, but the bear case looks at that exact same data and sees a worst case continuation lower. Because let's talk about the execution risk of that 400 million backlog. A government backlog is often structured as an IDIQ, an indefinite delivery, indefinite quantity contract.
Yes, which is a crucial distinction.
Right. It is a ceiling of potential spending. It is not a guaranteed check.
No, a backlog is essentially a hunting license. It means the government has pre-approved you to bid on specific task orders up to a certain dollar amount. But you still have to win those individual task orders, execute the work, and actually bill for the hours.
And the bears point directly to the 19% revenue decline as proof that BigBear's management historically struggles to convert backlog into recognized revenue.
Exactly. Furthermore, they are facing intense competition from massive tech giants who are also building secure, air-gapped AI solutions for the government. And they have severe exposure to government spending cuts.
Right. If the defense budget tightens or if procurement cycles just slow down, those backlog contracts could be delayed indefinitely.
The cash burn continues, but the revenue never arrives.
So what does this all mean for the everyday investor? Is this a classic value trap where retail traders get lured in by the AI buzzword and a cheap share price, just completely ignoring the massive execution risks?
Well, if we connect this to the bigger picture, a value trap occurs when a stock appears cheap based on historical highs or, narrative potential, but the underlying business is fundamentally deteriorating.
Like dropping from $9 to $3.85.
Exactly. Everyday investors look at a chart, see a stock down that much, and assume it must be a bargain. They buy into the AI buzzword, completely ignoring the 41.9 million operating cash burn. The danger for retail traders is trading the narrative, while institutional investors are trading the actual cash flows.
So where does this pressure cooker pop? Looking at the short-term versus long-term outlook, market expectations for the upcoming week of April 20th, 2026 suggest a very tight trading interval. Analysts project the stock will bounce between 372 and 398.
Yeah, it is expected to chop sideways within that pressurized room we talked about.
But there is a massive impending catalyst.
Oh yeah. The absolute defining moment for BBAI in the near term is the next earnings report, which drops on April 30th, 2026. The options chain for that April 30th expiration is actively pricing in heavy, heavy volatility. Traders are positioning for a massive move in either direction.
I mean, management has no room for error on this call. They have to prove that the Ask Sage expansion is actually generating that targeted annual recurring revenue. They must show concrete progress on converting that 400 million backlog into actual billed revenue.
Because if they report another top-line miss, the market will punish the continued revenue decline, and that 378 support floor is going to collapse.
It's going to be a wild week. So we've covered incredibly complex terrain today. Just to wrap up, we have a company bleeding nearly 20% of its revenue, yet fortified by a massive 462 million cash position secured through aggressive debt dilution.
Right.
We have top insiders taking capital out of the company while the stock sits near its lows. And we have a technical battleground where short-term buyers are absorbing massive sell volume under heavy long-term resistance.
It is the ultimate collision between the $6.67 narrative of an AI defense revolution and the $1.80 reality of a cash-burning operation.
Exactly. And I want to leave you with one final provocative thought to chew on or explore on your own. If BigBear AI truly has a secured 400 million contract backlog, and they just fortified their balance sheet with $500 million in cash, yet the stock remains heavily suppressed and insiders are selling, is the broader market simply mispricing an incredibly undervalued AI asset? Or do institutional investors foresee macro government spending cuts on the horizon that make that 400 million backlog nothing more than a mirage?
It's the exact tension driving the volatility. When the macro environment tightens, the promises of tomorrow are heavily discounted against the cash realities of today.
A mirage in the desert of a value trap, or the ground floor of an AI defense titan. We have laid out the data from our sources so you can weigh these sides yourself. Remember, no financial advice here. Thank you for joining us on this deep dive. Do us a favor right now, like the video, subscribe to the YouTube channel, and you absolutely must leave a comment below with your verdict.
Let us know what you think.
Based on the mechanics we unpacked today, is BBAI an undervalued gem or a retail value trap? We will see you in the comments, and we'll catch you on the next deep dive.